Jenny, how are you, my man?
I'm well, thank you, Jacob. It's a pleasure to be here.
Great to have you. It's good to get some background to start, and I'll give a little bit so you don't have to reiterate all the boring parts yourself over and over. Um, from what I could tell, you spent 5-ish years as a wealth manager at UBS. You also spent some time at Deutsche Bank and some time at a early stage blockchain startup. And then kind of around DeFi summer, you saw the light and saw that on chain and DeFi was something super prominent and interesting. And so since 2020, 2021, you've been running Re7 Capital. And today you have around $1 billion in assets you guys are managing. So first of all, does that all sound correct? And anything I missed that people should know about you as you jump into this conversation?
Yeah, no, that's pretty much to the point in the sense that I started in the traditional TradFi world, being kind of educated and disciplined on how things should be done. Then I started learning about the whole crypto world, where first time I heard about Bitcoin, didn't really get it, didn't make sense to me. But when I kind of jumped into the smart contract universe and the Ethereum universe, I got kind of excited by the use case that this technology enables. And then, as you pointed out, yeah, having seen DeFi pretty early on, it just blew my mind because having worked in a bank, a couple of banks, it's very easy to see how these new types of technologies can actually radically improve and change the world. And at some point, you have to bet on it.
On that mindset of like you saw the light early, there's a big narrative right now around bringing everything on chain, tokenizing things. We're getting regulatory clarity. So I guess broadly, how do you view the TradFi space as far as like how they're thinking about on chain, like today in 2025? Is it still pretty early and like seen as risky by the average person, or how do they view it right now?
So I think the word on chain means very different things to them and to someone like ourselves. So on chain in this context could mean two different things. On chain could be you're a TradFi institution number one, I'm a TradFi institution number two, and instead of doing a transaction which involves 25 people in the back office, we want to tokenize a mortgage instrument and settle it on a private blockchain or L2 that is gated and we control. So then in this world, on-chain is purely a very comfortable, secure settlement infrastructure. Now, the other on-chain world, which is where we spend our time, is the crazy wild west of finance, DeFi, and all those things, where you do very unusual things. You take unusual types of risks. Sometimes you take a little bit of risk, sometimes you take a lot of risk, and you pursue, abnormal rates of return. Now, when it comes to using on-chain tech stack, they're all over it, right? BlackRock and many others have tokenized different products. So that's happening. Different L2s have been spun up here and there. Stripe is doing their chain, so on and so forth. So that's a train that will never stop. But to a certain extent, I believe will exist in isolation from where we exist today as the on-chain kind of market participants. When it comes to DeFi, there are TradFi people who are starting to allocate to DeFi funds. There are some TradFi people who are saying, okay, well, let's allocate like a tiny, 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 tiny percentage of our capital and like in a very gated way, let's experiment. But, we're not yet at the point where, a large boring bank is going to go and transact on chain directly and, farm points on a random L2 that's too big.
Got it. Okay, and that's interesting. So it sounds like the big word that jumped out to me is permissioned versus permissionless. And the way that some of these big players are using it is almost like it's an improvement in efficiency to like improve settlements, but it's permissioned versus what we see as on chain is like we're trying to build global ledgers that anyone can tap into that has all these efficiencies of scale. Is that the right way to think about it?
That's right. And some TradFi institutions exist in both worlds, right? So some of them have RWAs that are, full KYC gated, and there's like an on-chain permissionless version of that. So they're experimenting because their regulatory environment has always been very friendly to them. Otherwise, these giants would not have, gone into the space. But yeah, it's kind of TBD how these two worlds collide exactly.
Okay. And then I guess one more question on this kind of tension between permissioned and permissionless. One thing I've seen when it comes to liquidity providers is this idea around whitelist pools or permission pools because you want to know who your counterparty is versus just like a global amalgam of all the people. But I don't have any pulse of like how common that is. Do you have any sense of that?
It's not very common. It's happening in a few gated opportunities here and there, because once you have that, that kind of immediately breaks the DeFi composability effect, right? Because you may have something that's fully gated on a public chain, but if it's fully gated, it's fully isolated. So these things exist, but they exist in isolation, and there are more and more of them. But I think as percentage of overall DeFi on-chain activity, these are still pretty small.
Okay. Um, we're gonna get into a bunch of nuanced topics around curation and risk management. But first, I want to have people to have kind of a level set of what you do. And so, could you give us a brief overview of what Re7 Capital does,
Mm.
and then also the extension arm of Re7?
Yeah, absolutely. Yeah, I launched Re7 Capital a bit less than 5 years ago with the idea that DeFi offers a very unusual risk return profile. And I don't mean the numbers, I mean the source of risk, because any professional allocator doesn't, or at least shouldn't be thinking about the expected rate of return first. They should be thinking about what type of risk they're taking. And DeFi basically pays you pretty high yields in exchange for taking smart contract risk. Right. So you're dealing with software that's, well, to put it very simply, not as secure as putting your money with with a JP Morgan. Obviously, there are trade-offs between open and closed systems, and there are, known risks and nuances there. But generally speaking, smart contract risk is very, very real, and hacks happen, and, sometimes stablecoins depeg and other things happen. But these things are typically extremely uncorrelated to anything else that's happening in the world. So if you're an investor who has money on Binance, if you're an investor who is long BTC, if you're an investor who has some bonds in their portfolio or real estate or whatever, and there's a global recession and markets are down, it doesn't mean that DeFi software is more or less secure, and vice versa. So these things offset each other. So I had this idea that there's a possibility to launch a new type of strategy where you take software risk in exchange for getting paid, pretty high yields. So with that, the first product we have ever done is, and continues to be, basically a market neutral yield fund, where you can earn yields via stable coins on chain, pretty high yields with a bunch of risk, obviously, but in a full liquid fashion. And that was the starting point. That's what the kind of Re7 Capital brand kind of emerged around that. Over time, we've added more funds, more investment strategies, the most recent one being a Bitcoin yield strategy. And then as this kind of set of strategies matured, as the ecosystem matured, there appeared that DeFi has started to become much more composable and kind of multi-layered, where within some platforms there emerged opportunities to basically spin up what is currently called, Vault infrastructure, and basically spin up, lending markets or more bespoke strategies and that sort of thing. And with that, basically a bunch of people joined Re7 to set up and found Re7 Labs, which operates as a separate entity that pursues and sets up these kind of on-chain vaults, which are fully permissionless and act more like a mid-layer stack in the DeFi infrastructure, rather than a strategy where someone comes and says, hey, I'm giving you capital, do whatever you want with it, within, like, go and figure it out. So in traditional world, that's kind of the difference between the execution and discretion, right? So you can call your banker and say, I want you to buy me Apple shares. Or you call your banker and say, hey, I am an aggressive investor. Take my dollar and do whatever you want with it within my, like, aggressive risk return profile. And these two things exist in parallel, with different teams running, different products and different strategies. And we've scaled to be a pretty, active player in the DeFi space.
Interesting. I think one thing underlying this I want to tease out is in a different interview, I watched one with the Angels to Allocators podcast, which people should definitely go watch. It's a fantastic hour-long episode with you and Andrew. You had this line that you label yourself the responsible degens, which, first of all, great tagline. Like that just belongs on a shirt and bumper sticker. But it does call out, especially during DeFi summer, it was like all about crazy yields. Triple digits weren't totally uncommon. And then we saw a lot of blow ups and like what was sustainable. And I think one thing you guys did early that was interesting was that you might get double digit yields, but they were much more robust and hedged better. So I'd love for you to tease out, like, why is it because of your TradFi background that you found that so like obvious, or like what went into thinking about that back then?
Well, back then, frankly, it was very simple without some very deep analysis, in the sense that, like everyone else, I was, just experimenting on chain with, like, super small amounts of capital, just trying to learn and figure out how it all works. And, as I was playing DeFi, I was like, oh my God, these yields are just ridiculously high. And by ridiculously high, I mean like 30%. I'm not talking about, the crazy ones, because for a TradFi guy, 30% is as insane as it gets. So I thought, okay, well, it's really cool and really exciting. And I believe that the space can really grow. So maybe there is a way to create an investment strategy around that. But you can only run capital professionally if you have a risk management framework. Because if you don't, then eventually you'll just blow up. So I started then back in the day spending all of my time thinking about the methodology for that. And then it hit me that, like, to be in DeFi, we love this line kind of, responsible degens, because you need to be a little bit degen at heart. You need to be an adventurer to go and just venture on the frontiers of what's possible, but not in a traditional crypto way, right? You need to take risk very, very seriously. And then I realized that actually what like we all do in DeFi when we're looking for yield is extremely similar to credit markets. So imagine that, I would come to you and I would ask you to give me $100 loan. And then I would basically tell you, well, listen, I will either default on my loan or I will pay you back 110 or whatever it is at the end of the year. Now, to you, this sounds like a horrible risk return profile, because you'll either make 10% or you will lose 100%. But in reality, if you're like a mortgage firm or a bank, you know that you don't give out your full $100 portfolio to one guy. You give it to a million different people, and you analyze their risk, and you say, okay, I expect that I'm making it up 10% of my borrowers will default. And on average, I will recover 50 cents on a dollar. So then you kind of know how much you're going to lose. And then as long as your yield is higher, then you're pretty happy. And it's a little bit similar, because you take your stable coin or whatever else, you put it into a DeFi platform, and then you earn yield every block. But then tomorrow or 6 months from now or a year from now, the thing can default metaphorically, i.e. something bad happens, a blow up. So then I was like, okay, well, it's basically the same thing, just very different type of risk. So instead of looking at the balance sheet and saying, okay, are you a solvent company or not? We just need to look at code and take a probabilistic view as to whether it's relatively safe or relatively unsafe. So with that, we created a risk framework where every DeFi protocol we touch is analyzed across a bunch of different points and parameters. And then on a relative basis, we weigh up what is safer and what is less safe and what is more safe. Because ultimately, you can be in the business of risk avoidance. And then you're like, okay, I have USDC. I want to put it into tokenized T-bills, or I want to put it into Aave, which is an equivalent of like a risk-free rate, basically, by DeFi standards. Or you're like, okay, I want to earn more than that. And then in exchange, I'm taking some risk, because otherwise, well, that's just life. And then you know that sometimes you'll be wrong. And when you're wrong, you have to make sure your exposure is sized correctly. But ultimately, you create this kind of risk-based approach where you're not trying to chase the highest level of yield, but you're trying to chase the highest risk-adjusted rate of return. So, for example, with our investors, we're always very upfront, where we're saying we don't see our job as something that looks like giving you, highest yield we can source. It's, giving you the best yield we can get whilst we can sleep at night and have some level of confidence it's appropriate on a risk-adjusted basis.
That makes sense. Two questions popped up. The first one I want to touch on is, in TradFi, the risk-free rate is something like whatever the federal funding rate is, or T-bills, and that's your floor.
Yeah.
DeFi, I tried to search this for a little while, and there's many minds about this. Some market as 0 and just build off of that. Some use T-bills as like a proxy. How do you view the kind of like, and this leads into what you're saying about, wanting to sleep at night and kind of like first
Yeah.
don't lose the principal.
Yeah.
How do you view the risk-free rate in crypto?
So it's a great question. Like, the risk rate in TradFi is, like, if you think about it logically, US treasuries are not risk-free. They're just the least risky ones. And that's just a fact, right? The probability of something negative happening is not a 0. It's maybe like super, super, super tiny, but it's not fully risk-free. And we all know about inflation and, right? So in DeFi, there are two ways to think about it. One, you can absolutely correctly say, well, actually, nothing is risk-free. So therefore, it's, USDC in your wallet. But I would go one step further, and I would say, well, that's not risk-free either, because what if you chose the wrong stablecoin? And maybe USDC is okay, but UST and and Luna Terra are not okay. So nothing is risk-free in DeFi in a traditional sense of the word. It's like, is it risk-free for you to keep an amount of capital with an American bank that is like insured up to that limit? Well, it's as close to risk-free as it gets. In DeFi, you don't have that. So then if I'm in a position where like I don't have anywhere to deploy my capital, I literally want to be in a risk-free zone, then we have to, off-ramp and put our money into a bank. And then we don't make any money, and then our investors pull out, and then we shut down the firm. Or you say, okay, well, nothing is truly risk-free, so we're doing it on a probability-weighted basis, where let's say there is a DeFi platform that we believe to be the least risky, but it's giving me X% yield, and everything else is giving me, X plus Y. But that Y is maybe very, very low because, like, let's say right now, yields are very low, market is very bad, very pessimistic. No one, yields are generally like lower across the board. So then what I might want to do is actually that spread is not attractive enough. So it's better for me to go into the equivalent of the least risky thing and earn a little bit less, but then be a little bit more protected kind of on a risk adjusted basis. So ultimately, you can pick the platform you think you like the most, or you trust the most, and it's pretty clear which ones are like the most battle tested and the longer standing ones. But even they're not risk free, so you can reduce your risk or increase your risk because risk is not a binary thing; it's a spectrum. And the main thing that we kind of are pretty, I guess, fixated on is actually diversification, because I don't know, let's say in the traditional world, you can look at, Coca-Cola and you can say, well, there's just no way that they're going to go bankrupt. And there are always unforeseen events and what have you, but it's really very low probability of a company like that. But in DeFi, there are lots of unknown unknowns. Right? Curve has been around for forever. They experienced the hack. Balancer, amazing team, just across the board. They've experienced an attack, and there are many other cases like that. So it's important to accept the limitations of your own knowledge. And there are lots of unknown unknowns. So, there are known unknowns, and then you can kind of manage them. And unknown unknowns, you just don't know what to do. And the only way to protect from that is to be diversified to such a point where no matter what blows up, you should be okay. And that's really the approach we take, because we know there's limit to what we know and can understand. There is limit to what DeFi knows. And there's always going to be someone smarter who's trying to, break the system. So put yourself in a position where no matter what breaks, you should be able to survive. And once you start behaving that way, it influences a lot of your decisions and really lets you sleep at night.
Excellent, excellent. I want to jump into vaults here in a second, but on that last point, about diversification, has that changed over time, and maybe more specifically recently? And I say that for two reasons. One, I remember talking to someone from EtherFi, and they're making the point that they were trying to remove their dependency on ETH specifically, because so much of DeFi, as ETH collapses, DeFi compresses a certain amount too. But then two, we had this recent really bloody day like a month or so ago where the market just tanked and liquidations happened, and it's just crazy. So there seems to be like, it's not correlated to the regular market, but crypto protocols are highly correlated. So has diversification shifted for you over time seeing some of these things?
So our framework has been evolving continuously. You keep learning, you keep making adjustments and changes, but structurally, frankly, nothing has changed, because we're not just saying, okay, let's put money into like a bunch of different protocols. We are also classifying them by the type of risk. So let me just give you, two very different examples. So example number one is, let's say theoretically someone is putting USDC and USDT into Uniswap, into the AMM pool. Now, if Binance goes to zero, like as long as you believe that USDT and USDC are solvent, then you're okay, right? I mean, let's forget what yield you may or may not be earning, but structurally, like, you don't care. If you have your USDC on, let's say, Aave that is being lent into the global market, then as long as the margin call, the liquidation mechanism, is strong enough to withstand, like if ETH goes from, 3,000 to a zero in a second, well, I'm sorry, but then, DeFi deserves to die, frankly. But even in a flash crash, the odds are the system will be able to withstand that liquidity shock. But if you're in both Uniswap and Aave in this specific example, then you're diversified already. And like these types of things, like we've seen these flash crashes before, right? It's not the first time, it's not the last time. And like our yield funds were unaffected by that date. In fact, it was one of the most profitable days we've ever experienced in our market neutral yield fund. So yeah, you do realistically have structural dependencies. Like anyone in the yield business in DeFi, if like Ethereum L1 goes down, like you're screwed, because then L2s go down and that's it, right? So you always have like some extremely structural dependencies, but it's a little bit like investing in the US, investing in a country, and there's a risk of like a revolution, or like it's comparable, and then you just have to like pick the chain correctly to make sure that's not the one going through a revolution kind of thing. Different people approach it differently, because an example of some of the protocols like EtherFi or what have you, it's harder to be very flexible, because when you operate a hedge fund, you can be extremely nimble within your kind of investment mandate, but it's much harder to do it as a protocol.
Got it. That makes sense. Okay, I wanna jump into vaults. I mean, there's like 4 or 5 big buckets of earning yield broadly. Speaking about BTC, yeah, like staking, you can do lending of some sort. Vaults have become a big topic this year, and they're getting increasingly popular. And I think first it's good to level set what they are, because historically Bitcoiners are late to tech because all the fun is happening on the other side of the crypto. And something you mentioned in the recent pod was that Morpho is a leader here in the sense that they decoupled the platform from the curator, which is interesting. But I'd love to get a quick overview of just like what are vaults before we jump in.
Yeah, that's a great question. And one of the problems of crypto is that it keeps inventing lingo that doesn't need to exist. So like the word vault is meaningless. It doesn't mean anything. It's like saying, it's an investment strategy. Okay, well, maybe your investment strategy is buying shares, and someone else's investment strategy is doing high frequency trading on like arbitrage or whatever. So we need to do better as an industry to make it clearer for people to understand what things actually are. So a vault is effectively, a box, right? It's a packaged wrapper, and within that wrapper, you have some investment logic. And the investment logic, like let's take Ethena as an example. So you give Athena your stable coins. It uses that capital to buy ETH, to short perps, and earns you that funding basis trade. That's what it does. And it's packaged up as a stable coin. Now, is it a stable coin? Well, yeah. Is it a tokenized hedge fund? Yes. Could you also say it's a vault that runs capital for you within a predefined mandate? Yes. But we think of it as a stable coin, not a vault, even though I could do exactly the same thing, maybe a little bit better, maybe a little bit worse, and I put it into a vault, and suddenly it's a vault, not a stable coin, but it's the same thing. So it's extremely important to separate that language and to understand what it is, because some vaults are lending, right? So you mentioned Morpho, for example. Anyone in the world can go and spin up basically a lending market that will have, Jacob coin. And if anyone wants to lend against Jacob coin, they're willing, it's their choice if they want to do it. And there you go. It's a vault that allows people to lend against a specific asset or against a variety of assets. Someone can come and say, well, there is a hedge fund. Let's tokenize that hedge fund and put it to the market as a vault. Or someone can come and say, well, I really believe that if you do trade number 1, trade number 2, and trade number 3, they're absolutely amazing. So let's put them together into a vault and offer those specific trades to people. So I know it's a very vague answer, but that's because the terminology is so vague and anything can be a vault. That's where communication and education is highly important.
Yeah, that was my next question, which is that I like the idea. So yeah, you have an input. In this case, let's say it's BTC, but it could be stables or it could be a basket sometimes. It goes in this container. And I guess the next question is like you mentioned a box, and sometimes it seems like it's a black box, which is that they have like the company has their reputation, they have a gamut of who does things transparently or not. It's like all over the place. Some of them are super permissioned and they can go here to here and you can track it all. Very few do that very well, in my opinion, as far as I could tell. But again, I'm looking at the BTC side, which is still early.
Mhm.
But yeah, how should people think of this when it comes to like, okay, they understand this box, but they're trying to discern what's a good box or not.
I understand.
What are they looking for?
That's a very good question because and that's something I learned back in my TradFi days. When you're speaking to an allocator and you're explaining them anything on the investment side, the first thing is that they need to understand how much they can lose if things go south. Because that's the most important thing. The most important thing is not how much money you're going to make if things go right. It's how much you're going to lose when things go poorly, because that will help you size your position. And maybe it should be a zero, or maybe it should be a very large percentage of your portfolio. That's kind of up to you. So what can you do really, right? You know, maybe taking a step back a little bit, it's like if someone comes to you and tells you, hey, there's a DeFi vault that does something with your Bitcoin, and someone else comes to you and says, hey, I run a hedge fund. Intuitively, you will be more like, at least my experience with on-chain people is that you'll be more hesitant with a hedge fund because like, hey, like you guys, like it's a Cayman fund or like whatever. Like, I don't know what you guys do. And you're just hesitant because it feels there's paperwork involved. You need to sign a bunch of, disclaimers. But with the vault, it's one button and a website with with a monkey. So, but the underlying question should be the same, right? So if anyone is looking at the strategy, they need to be like, okay, do I understand what this strategy actually does? If you don't understand, then, don't go into that strategy. Don't go into that vault. If you don't understand, but you can speak to someone, maybe someone who is running that strategy, or maybe, an interface that's offering that strategy to you, then you need to go into your research, or you need to trust the brand. Right. So, but ultimately, you need to understand that you're just skipping the research phase because you're choosing to put your faith into a person or whatever. Like when we have, and, being very kind of, direct and realistic here, like if someone comes and wants to be an investor in our fund, some people, like with some people, it took them 2 years. They've gone through a lot of processes. They've done their process, their systems tooling and whatever. And like, okay, we took us 2 years. We ran you through all the checks and balances, and we're gonna invest some capital with you. Someone else comes and says, hey, I know my friend is invested with you. He says you're a good guy, so I'm just going to put some money. And it's just different way, and obviously different sizes as well. So people have this different approach. So I think that's where sizing becomes very important, right? So either you understand what the box does, or you can go and talk to someone to figure out what it does, or you don't get it, you don't have anyone to speak to, but you trust the brand, and then you just go in, well, frankly, blindly, like many people do with DeFi platforms, right? How many people who put money into DeFi platforms actually read the code? They don't, right? Like, okay, I've seen these guys on Twitter, they're probably okay, and they did like a partnership announcement. So people need to understand, this is like not a video game. These are real risks, and like I've taken losses many times in the space, as most people probably have, and you learn the hard way, but you just need to be very realistic about your depth of understanding of whatever you're touching on the investment side.
It's great. Okay. And I'd love to get in the weeds specifically on a couple that you guys manage. So a couple that we've recently wrote reports on is Acre from Mezzo, which you guys are managing. And then Starknet's been doing a big push into BTC-Fi recently, and you guys have been doing some big stuff there as well. So for people who like the advertised rate on Mezzo and Acre, I think is 14%, but I couldn't find like real on-chain data for that one. But yeah, I'd love for people to understand more about these two specifically because they definitely touch Bitcoin uh, pretty directly.
Well, when it comes to, so we tend to think about things in terms of like the risk return curve. So you have the risk free or the equivalent of risk free, and then, you go up the risk curve. And it's interesting you brought up Starknet, right? So Starknet, they've gone through this kind of massive upgrade where now you can actually stake Bitcoin on Starknet. And again, I'm very hesitant to use the words risk free, but in TradFi, that another way how you can call it is a benchmark rate. So you take the benchmark rate as a starting point, and then you add layers of risk on top. So for example, I would probably say that staking BTC on Starknet is the equivalent of a benchmark rate, meaning it's not risk-free, but it's hard to find something that's less risky unless you're just, not doing anything, obviously. So that's what, when we learned that that's going to happen, we're like, okay, well, you could really build like an interesting ecosystem around that, because then you can have LSTs on BTC, and then you can have lending and like lending looping and those types of things. Like we've had, back in the day when ETH staking yields were high, and levered looping on LST is obviously like as vanilla as it gets in terms of like risk adjusted returns. So we've been more like Re7 Labs has been working with Vasu on some of the like BTC lending vaults, and then just making sure that the AMM liquidity and other things are kind of are in place. And then you go further, right? So, okay, so let's say you can do Bitcoin staking, and there are obviously other chains where you can do it in indirect fashion or restaking. Then you have LSTs, then you can take your Bitcoin, put it into DeFi, and do all the usual things that you can. Um, and Starknet is just a great ecosystem, given how serious they are about security and how much they prioritize it. And frankly, that's really all you can do within DeFi. You can do a version of staking or restaking, and a little bit in DeFi here and there around those types of staked assets. So we've been getting a lot of inbound demand for a Bitcoin yield strategy for a long time, because we've been primarily focused on just stablecoin dollar yield. And we've been hesitant to roll it out because, like I mentioned, our critical and key point is being extremely diversified. And on the Bitcoin DeFi side of things, it's really hard to do that. So you can be a bit more overweight on an ecosystem like Starknet because you may feel, or at least we feel strongly, that on the security side, at least we feel comfortable with those risks. But it wasn't enough. And then we've have had some experience with options and volatility trading in house, which obviously happens in CeFi rather than DeFi, because in DeFi option markets are, well, they kind of exist, but there's not enough liquidity to do things at scale. Anyone who comes from TradFi knows that, kind of selling volatility is risky, is kind of a treacherous investment strategy. But if you do it well, you can earn pretty interesting yields. So then earlier this year, we brought on an asset manager who has just a phenomenal track record of running that. And that's kind of how we packaged up our own Bitcoin strategy, where you can do some staking, which is, the benchmark. You can do some stuff in DeFi, which is lower yield and maybe some more aggressive strategies with like volatility, but, risk adjusted, it's great. And then, you go kind of on the offensive with some of the vol trading. So that's kind of one thing you can do conceptually on the Bitcoin side. And in our case, is also packaged up as like tokenized fund, where in the back end, all of that happens with risk that is being taken. And then the other thing you can do, obviously, is you take your BTC in some shape or form and you borrow against it. And you take those stable coins and you, for example, put them into a stablecoin yield strategy, which could be a fund or whatever else. These are the two like categories of things that we're comfortable doing and where we have some degree of expertise. And that's really what we've been focusing on, and then trying to obviously evolve it and perform. And then one point to also mention, which is we're working very actively to kind of educate the community on that sometimes these yields are not linear. So if you, in DeFi, we're a little bit spoiled where like, okay, we're going to get our 10% yield or whatever. And, every block you just earn. It's very easy to annualize your return and advertise a number or be very happy with a number. When you're doing some more sophisticated things, let's say, volatility stuff, you can be in a situation where like you make no money for 3 months and then there's a massive spike, like plus 10% in a month. And then for 2 more months, you actually lose a little bit, which means that you need to it's not enough to just look at the APY. You actually need to understand the nuances a little bit deeper and kind of go further, because unless you're just borrowing against your BTC and putting stablecoins to work, it's not going to be a linear payoff.
Great answer. So just to recap, there's three main buckets. You have staking, which typically will pay in an altcoin and gets converted back into BTC, I'm assuming. And that's largely consistent, though altcoins tend to trend down to the right, but you can kind of watch that. Options, premium, and trading volatility, which, as you said, is like super spiky when it's good that you eat like crazy Thanksgiving, but most of the time it's very hit and miss. And then borrow, stablecoin, yield, those are kind of like mature markets. One thing on the benchmark rate that's interesting is depending where you land on the custodial risk. Some people see something like Babylon or maybe Core by extension as the benchmark rate, which is that you stake BTC in some kind of like time locked contract. There's no slashing in those protocols, so your risk is very low, and you're just kind of like losing the option of your BTC to do something else with it. And you're going to get, I think 0.05 is the new Babylon rate. Core is something also very low for just BTC only. But Starknet as the benchmark rate can be, 5%, but you can't do direct BTC with that one. You're going to be in a wrapped asset first. I think TBTC, which is a pretty strong running decentralized one, or WBTC. So I just want to make sure, like, one, people know that's interesting. There's like a BTC benchmark rate for some people, and then there's the wrapped asset. But it sounds like you guys see those tokens as robust given their longevity.
Well, again, we're never publicly advertising or endorsing anything, but we have felt comfortable enough to put our own capital into that. That's how I would kind of address that. And like if someone comes to us and says, "Hey, you should stake your asset, your BDC, and you're going to make 0.5%," like, what's the point?
Right.
Right. So like you do need to be cautious and gradual in your kind of capital deployment, but also it has to make sense.
Yep.
Right.
That makes sense.
But ultimately, yeah, it's, you bring up an important point because these are all trade-offs, right? So people choose their own poison in a way, right? They choose the risk they're comfortable with. And we've chosen this, but someone else might, very rightly choose something else.
Okay. Excellent. I want to start to close this down. A couple last questions. We've been running for 40 minutes. This has been fantastic. But real quick, anything on this topic around vaults I didn't ask that you think is worth noting?
I think we've covered a lot of ground.
Okay, cool. Then hard left turn. At the end of the other part I mentioned, the angels to allocators, you mentioned something about you were exploring what does it mean as blockchain companies start to IPO. And Circle was one of the examples. And what does that mean for tokens and these, a lot for the longest time, people have seen tokens as like quasi equity on chain, these kind of things. And that podcast was 4 months ago. Interesting question. Any thoughts post that, or what do you think about this space?
Yeah, it's, if anything, that challenge and that gap has become even more evident, right? Where all, obviously, like, all the markets are down, crypto stocks are down, and DATs are down, like everything is down, clearly. But these questions are more and more profound because there are more IPOs that have happened since. There are more that are about to happen. And like we've had a bunch of cases, like there was one specific case that comes to mind where Coinbase acquired a team and a project that has had a live token. So the team and probably the IP goes to Coinbase. Like, what's going to happen to the token? Because that project is not going to exist anymore, and the team is going to work on something else. So this kind of idea of like token holder rights and those types of things in the bear market is becoming more and more pronounced. Because when markets are bullish, no one cares. Because coins go up, some more, some less, but generally everyone is more or less making money, so no one is asking the hard questions. So, lots of alts are down, 80-90% year to date. So, if someone doesn't call it a bear market, then go and throw a stone at me. Because if you're announced, it's definitely a bear market. And yeah, it's like, how do you justify holding these assets? There are cases like, let's say, Hyperliquid and a couple of others where it's a business, generates cash. Cash is used to buy back the token, so you can kind of engineer, the upside case. But in most other cases, why should that asset be worth more than a zero? And, it's not very easy to get to give an answer. So I'm still battling with the same question. Yeah, foolishly haven't sold in our, we have a long only fund, we haven't exited in favor of stocks, and we'll see how kind of things look on the other end. I don't think tokens are going to disappear because they do have a certain utility function that's very rare in terms of their ability to bootstrap, the early kind of traction. But clearly something needs to change because when we do hit a real bear market, a lot of them will just never recover.
Perfect. Well, Evgeny, this has been fantastic. Thanks for coming on and dropping knowledge and educating us. Yeah, for everyone listening, links will be below for everything that we talked about. But thank you for coming on the show.